All evening traders, and it's Sunday night, and tomorrow is the first trading day of May 2023. So Sunday night's always a good time to catch up with what's going on in the markets and to reflect and to take some time just to consider what's been going on and how you're going with your trading. And hopefully you've had a restful weekend and have been able to gather your thoughts and take a break, take a rest, and chill out a little bit, get ready for the markets this coming week. Last month, April, was a tough month for me, so I'm looking forward to a much better month in May. And I'm going to go through some of the main trading ideas that I've got for the days and the weeks that lie ahead. So I'm going to start with currencies, and then we'll go through some of the commodities and one or two interesting commodities that have popped up on the radar that you might be interested in if you're trading commodities. And we'll also look at stocks, stock indices, and a couple of the big names on the NASDAQ and on the S&P. Let's start with the dollar index as normal. And, this is a tricky one. So, in fact, we can go all the way back to sort of the mid-March, and we've really gone nowhere since about the 21st, 22nd of March. And we're now at the 1st of May coming up tomorrow. So really just a sideways movement on the dollar against the major currencies. And when we look at the euro and the pound and the yen and so on, you'll see that this has been a very tricky range to trade with lots of sort of false breakouts to the top and to the bottom, and leaving us with very little directional trade. And you can see it right here on the dollar index. On Friday, the dollar index actually showed an interesting move higher, spiking up above the 20-period moving average and making a new high. In fact, the highest peak of the whole week on Friday afternoon. But then we collapsed back down again and closed beneath that 20-day moving average. However, we did form a higher high and a higher low on Friday's candle, despite that wick top. And we're still also at this very long-term support level at just above 100, at 100.8, forming this sort of double bottom, almost a triple bottom on Wednesday, and then just holding above there. So the jury's still out on the dollar, and I think a lot of it is going to depend on what the Fed says after their probable 25 basis point hike in interest rates. And a lot of it is going to depend on what Jerome Powell says half an hour later regarding the rate of future hikes, a potential pause. I think he's going to say a lot about looking at the data, and we'll decide when we look at the data. But I think he'll open the door for a possibility of a rate hike pause. I don't think it's going to be a pivot. I don't think he's going to use words that denote pivot. But I think he's going to say we might look at potentially pausing the rate hikes going forward after Wednesday. So that's taking place on Wednesday this week. Having said that, let's look at the euro and the pound. And I'm only going to look at the euro, the pound, and the Australian dollar, and then we'll go across and have a look at the yen pairs. The yen did have a big rally after the Bank of Japan's non-interest rate hike and comments thereafter. But let's have a look at the euro. Euro looked like for a moment it was going to break down below this channel line and this 20-day moving average just below. But we were held up by this red support line, and it's a fairly minor support line, but you can see it's actually been respected by the price, and we formed a wick low, which could be interpreted as either a bullish rejection from that support, or it might be interpreted by some as a hanging man candle after a wick high a few days ago, a sort of a hanging man candle on Thursday, and then something similar to a hanging man on Friday as well. So I don't think this rejection from the 20-day moving average and the support line with a wick low is necessarily bullish, but I also certainly don't think it's bearish either. And until we break out of this range that we've been in since, again, sort of mid-April, just faffing around, holding above the 20-period moving average, until that happens, we can't say which way this is going to go. There's every chance is that the euro will reach up back to this channel top, and that could take us up to as high as 1.12 and potentially even higher. We haven't managed to reach that channel top again yet, and that's normally a bearish sign when the channel top is not reached and the channel bottom gets breached, even though we didn't hold beneath it. So if anything, with these wick highs and this sort of tweezer top against the channel top there, with the bearish engulfing candle, a tweezer top on Wednesday, and then two potential hanging man candle patterns, there's every possibility that the euro will want to move lower. And again, we've got the FOMC interest rate decision and statement thereafter on Wednesday coming up, which I guess will have a large impact on all of the markets, including the currency markets. For now, however, we're going to remain bearish on the euro until we see evidence of a break above 1.1, which is a very key number as it turns out. Markets respected that several times. If I draw a line straight across the top here, at 1.1 precisely, you can see it's the top of these candle bodies, and we haven't managed to close above that level since February this year. We'll have to wait and see what happens. As I said, for now we remain bearish on the euro, but very, very tentatively. Same sort of thing on the pound, although we have broken up to a new high on the pound, but we're running into a resistance level. That green line above us at about 1.265 thereabouts is a is a pretty significant resistance level going back some time. And overall, I think the British economy, despite the very high inflation rates and the danger of further more dramatic interest rate increases, I think overall the weight on the British economy and the European economy might overcome potential further interest rate hikes. And I'm also not sure whether we're going to see dramatic and prolonged periods of interest rate hikes going further, given the fragility of those economies at the moment. So a lot of it's going to also depend on what the forecast and outlook is for interest rate hikes in both the UK and Europe going forward. Having said all of that, I think this level here at 1.2650 might provide some serious resistance for the pound to overcome, and that we might not get much higher than there. Perhaps a brief spike through there to 1.27, and then a move back down to some of these support levels starting at 1.2 and then perhaps down to 1.18. So we remain bearish on the pound as long as we're below 1.2650, maybe 1.27, and at the extreme 1.28. So that's covered the major currencies against the dollar. The next ones I want to look at are the yen pairs, and we've been caught a little bit short throughout this period on euro yen. Basically, that's the only one we've been trading. We have been short CAD yen through this period downwards. We haven't been selling CAD yen recently, but we have been looking to sell euro yen until Friday pushed us out of those short trades by moving dramatically higher, with the yen, the dollar yen over here on the left, moving up through that resistance. Let's start with the dollar yen because that one's going to affect all of the others, and dollar yen's really interesting. Right up above us, we've got this downward sloping head and shoulders head. If you remember a few videos ago, now going back perhaps a month or two, I identified this level where this black line is, this head and shoulders shoulder line, denoting the left and the right shoulders slightly sloped down. It also happens to be where the 200-day moving average is, and that's going to provide a really key resistance level, which would also be a double top against this level going back to the 7th of March. And that level right now is at about 137 to 138 in that region there. And I expect that we're going to find a great deal of difficulty overcoming that. Overall, I think the direction for the dollar yen needs to be down, and I think we need to get back into some more reasonable and sensible levels, which the Bank of Japan I think will agree with me on, and that's down into the sort of 120 to 125 level, perhaps even lower than that. There have been periods of intervention. When the dollar yen reached up into the 150 region, there were periods of intervention spanning a couple of months where the Bank of Japan and the Japanese government deliberately strengthened the yen against the dollar through intervention. And you can see that happened on a couple of occasions. And there was also one occasion when they were murmuring about potentially raising the interest rate from minus 0.1 up to perhaps just 0 or maybe slightly positive. So there have been murmurings and there have been interventions which have driven this price down. We're now beginning to creep up into levels which I feel they might feel uncomfortable with. So look to sell the dollar yen somewhere around about 137 to 138, allowing for a brief spike up to this previous left-hand shoulder high, which is at around 139.50, perhaps even 140. But I think we'll see renewed selling pressure in the dollar yen as we reach into those levels. And perhaps we won't even get past 137 or 137.20. Now that we've seen the dollar yen, we can have a look at the other currencies against the yen. And I'm not going to discuss the Australian dollar yen and the CAD yen, but same concepts and ideas will apply roughly to those two. But let's have a look at the euro yen because this is the most interesting of all of these. I've got the euro yen weekly chart on here, and we have to go back a long way before we see levels that we've reached right now. And we're up at around 150. Last time we were there was in 2015. And if we go even further back, we have to get to August 2008 before we see levels of these magnitudes. Now, if I draw a Fibonacci level from that August 2008 level from the top at around 169 to the bottom at around 93, believe it or not, you can see that we've bounced off the bottom. We've retraced all the way back up to this 150, big round number, big beautiful 150 number, obviously a psychological number. But just above there, we've got the 78.6% Fibonacci level at 153.80. That's the 78.6% retracement of the move down from this top down to this bottom. And that's also a pretty significant resistance level, because if I draw a horizontal line in there as well, across at that level, you can see this red line cuts through those bottoms going back into 2008. So if 150 doesn't hold, and we're short from here right now, if 150 doesn't hold, we can expect the euro yen to try to move up to 153.80. We don't expect that the price will be able to move much higher than that. And this level here was an extreme during the 2008 financial crisis, which may or may not actually happen in this next year or two. Of course, with all the doom and gloom and recession predictions going on. Whether those will turn out to be correct or not, it's pretty difficult to say. But if that is the case, we could actually see euro yen moving higher, depending on how the euro reacts against the dollar. having said all of that, this number here at 150, it's a beautiful high there. It's a beautiful supply region there. It's a big, beautiful round number at 150. It's not only 100, but it's a 50 as well. So it's a 1.5, one of the most powerful numbers on the chart. That's why we reacted to that level before. So we're short from this level, but I'm prepared to stop this trade out and try again as we move up into the 153.50 region and look for another short opportunity over there. So that's the euro yen overall. And I think out of all of the yen pairs, this is the most interesting. So we're keeping a close eye on the dollar yen and the euro yen. And I think the CAD yen and the Aussie yen will follow suit generally in the way that these two trade, euro yen and dollar yen. I'm going to briefly look at commodities. I'm not going to cover natural gas because I've just done a video on natural gas. I published that yesterday, and that was the video before this one on my YouTube channel. I'll put a link to that at the end of this video. But if you go to my channel homepage, you'll be able to find that video, which I put up yesterday on natural gas. Let's just have a look at Bitcoin very quickly. So Bitcoin, I really don't know. We've got this resistance level at about 30,000, and we've got another one up above us at about 32,000, 32.5. And those levels are derived from previous lows after that last rally and dip down and move back up again and so on. I'm not going to go into detail on that, but you can have a look at your longer term charts and you'll see where these come from. The problem with Bitcoin bears is that we've got this channel that we broke out of, held beautifully above, moved up into that 31,000 region, fell back down, just dipped below the top of this channel, but very, very quickly recovered and bounced off the 50-day moving average out of this pink support level. And we've now moved above it and also forming a sort of a bullish triangle. These are live charts as Bitcoin trades 24/7, and it's looking like it wants to move up tonight on Sunday. So I don't know. I think if you're going to be bearish on Bitcoin, which I think I generally am considering the economic conditions and the flight potentially coming up out of risk assets and so on, that Bitcoin might move down a little bit. However, it does seem like Bitcoin's becoming viewed as a lower risk asset, and along with gold, it's been pretty strong and holding its own against choppy and mixed up and crazy markets. Bitcoin's been really solid, and apart from that dip down just sort of middle of March, after that rally starting right at the beginning of the year, we had a brief dip down in March, back down just below 20,000, and ever since then it's looked awfully strong. So I think betting against Bitcoin at this stage is tricky, but I'm also not sure if I'd like to be buying Bitcoin. So I'd like to see a rally up into much higher levels before potentially looking to trade a pullback short or a strong move down to perhaps buy into, or some reversal candles or signals where we are at the moment to look to sell. I really don't know. And I think the risk reward equation on Bitcoin in either direction right now isn't great. So I'm going to be leaving that one alone. Gold, on the other hand, I think remains a good bullish prospect, and I think the levels are pretty clear on gold. We've got this downward sloping top channel line which would act as support, and also the 50-day moving average, and that's all coming up to meet at around about 1950. Below that we've got this red line about 1920, and below that we've got the 38% Fibonacci retracement level at about 1880. I think gold will look to base and form a new support level somewhere between 1880 and 1920. I think that's the best region to bet upon to look to buy gold. It is possible though that we could get a dip down into this lower level here at just around 1800 to 1825, and that would be a 50% pullback to recent lows, the 200-day moving average, an even stronger base from which to launch a new attack at these highs at around 2075. So a little bit like Bitcoin, it's probably not worth looking to buy gold at these levels, and I certainly wouldn't be betting against gold at these levels. So I'm personally going to wait for a pullback, starting to look at maybe dabbling at 1950 and then 1920, 1880, and allowing for a potential extreme pullback down into the 1820 to 1800 levels to form a new base once again, potential double bottom against the 200-day moving average and this 50% fib and this green support line. So anywhere below where we are at the moment, down to about 1920, all the way down to 1820. That sort of region, looking to buy gold. I know that's a very broad region, and we'll have to be trading this nimbly and watching the levels, watching for reversals, perhaps getting in and out, perhaps getting stopped out once or twice, perhaps getting out at break even a few times. But I think overall, we're looking for gold eventually to move back up to 2,000. We're just below it at the moment. And then once we get through 2,000 and this high at 2,050 up to 2075 and then into new highs for 2023, perhaps even up to 2,200, 2,400, maybe even 2,500. So that's gold. I'm not going to talk about sugar. It's a little bit of a sore point at the moment, but there is a video up on my channel page on sugar and the trade that I lost on sugar trying to short it at around about the 20 to 21 cents per pound region, and we're now up at 26 to 27, almost getting to 28. I'm still overall in favor of the idea of shorting sugar, but if we do see a dramatic rise in the price of Brent crude and WTI, that might fuel a further move higher on sugar, and ethanol derived from sugar is a competitor to oil in terms of internal combustion engines and a couple of other uses, so any rise in the increase in the oil price could put further upward pressure on sugar. However, overall, I'm looking for sugar to move down back into the 20 to 21 cents per pound region, and I'm closely watching this for signs of reversal to reshort sugar back into some of those levels. And the first level of support would be this red line here at around about 21.80 to 22 cents per pound, somewhere in that region there. And that would be a sensible target for sugar shorts. If you want to have a look at the way I've traded this last time, go and have a look at the video on my channel. Let's look at WTI, or it could be crude oil, depending on what you're trading. Brent crude. And you can see we just had a simple channel line drawn here. We ignored this sort of dramatic dip low. We've ignored that gap after the OPEC production cut. We've moved back through, filled that gap, just dropped through the gap a little bit beneath these moving averages, back down to that trend line, and we've bounced off it. So we've been short on WTI from this top here, and we traded it back into the gap. And during last week, we reversed that trade and went long off the support line, and we're now flat. And after seeing how this has held up and formed a beautiful reversal off this trend line, we'll be looking to re-enter longs on WTI going into the week, aiming for the channel top and eventually a breakout through the top of this channel up into higher levels. I think the demand for oil is going to increase throughout 2023, and I think we've got a great opportunity to buy it at these relatively low levels of this beautiful technical support structure. One more commodity I want to have a super quick look at, and that's uranium. So I put a little tweet up on my Twitter channel with some links to my thoughts on uranium. Go and have a look at that if you want some more detail on this. And I think we've got a great opportunity to buy this ETF. It's called URA, Global X Uranium ETF, and I can trade it on my broker with Black Bull, and I'm sure you can trade it with many brokers. And I think this line here is providing a fantastic opportunity for us to get long off a technical foundation on the charts against an overall global demand for uranium for nuclear power plants. If we switch this chart across to the weekly view, you can see why this level is so key. It's the 200-week moving average just below us, and this red line is a previous resistance level, then it was support, then it was support, and again, and again, and again, and again, several times in a row, 4 or 5 or 6 times, including the resistance there. And we've got the 200-period moving average just below it. And I think overall, even though that's a descending triangle, I think we might well hold up above here. And on the weekly view, you can see we've got a nice bullish setup forming on the weekly chart with these spike lows down here and the spike low over here. And I think we have a good chance of this ETF rallying back into the 23 to 24 region, and then perhaps all the way up to 30 or so, thereabouts. Going back to the day chart, you can see we've got a constructive chart pattern forming here since the middle of March this year, and to me that looks pretty good. We're at the round number 20, and if we can break up above 20 and hold above there on a daily basis, we've got every chance of moving up into 23 or 24 and then eventually 30. So I think this is a good opportunity. I'm going to be looking to buy this ETF tomorrow, Monday, the 1st of May, 2023. And let's see how that goes. We have a good risk reward ratio because we know where the stop loss needs to be, just below these support levels here. Perhaps that one going back into 2021. That's at about 17 or so. And we've got a high target of 23 up to about 30. So we're risking about $3 and we're aiming for a game of about $10. So we've got about a 3.3 to 1 reward to risk ratio, which is exactly the sort of trade I like to take. Well, I think those are all my thoughts this weekend, preparing for next week's trading. Good luck with that. And if you enjoyed the content in this video, please give it a thumbs up. And if you're new to this channel, why not subscribe and make sure you get all the video updates as they come out.